Well, it's been an interesting week. Gold rewriting the record book this week. It punched above $3,500 an ounce as markets bet the Fed will cut rates at its meeting in mid-September. Silver is at a 14-year high. Canada's TSX has been notching fresh records with gold miners in the lead. In base metals, China's refined copper output is usually or unusually expected to dip in September. So with that backdrop, we're joined by John Ng, portfolio manager and analyst at Maison Placements, to help us frame the opportunities and risks. John, thanks very much indeed for talking to us.
Good to be here, Devan.
Look, it's been an interesting week. We've seen stocks, bonds, and commodities all move sharply on rate cut bets. Is this a broad repricing of risk, you think, John, or mainly a precious metals story? What is it?
Well, I'm afraid it's Trump, Trump, Trump. What's happening now is the geopolitical conditions are messy. The domestic conditions in the United States have become messy. The firing of Lisa Cook, the independence of the Fed has cast some doubt about the longevity of the U.S. dollar. In addition, you have not only the threat of independence in the United States of the Fed, but you also have central bank buying of gold. Again, for the 9th month in a row, the Chinese have been buying gold. And in fact, if you look at the last 3 years, central banks have been buying 1,000 tons a year. That's almost a third of the supply. And that consistent demand has now come when retail demand has been resurrected because of the Trump uncertainties. So in fact, you have that push upwards for the demand of gold. Meanwhile, supply is a big problem for the gold mining industry. We saw in the second quarter terrific cash flows, but the difficulty is for a lot of these producers, Devan, is the replacement of reserves. We have to remember that, in fact, gold miners are depleting their reserves. And year on year, we have seen difficulty for the big ones, in particular, for replacing the reserves. So that combination has pushed up the metal price. The question that everybody asks is, how high and what's the target? Well, I can recall a long ago when $2,200 was the target. Now we're talking about $3,500, probably $4,000. There's really, conditions are so uncertain that how high is the moon? I don't know.
Well, look, let's talk about that miners versus metal again on the TSX, right? The index keeps setting records with help from gold names. At these prices, where do you see margin expansion and balance sheet risks if bullion corrects?
Well, if bullion corrects, the average all-in cost of the producers are around between $1,400 and $1,600 an ounce. So bullion could correct 10, 20%, and there'd be not a problem. The gold mining industry's balance sheets are in great shape, other than, say, maybe a Côté, which spent to build out IAM Gold, to build out Côté. Really, the gold mining industry, particularly one like Agnico Eagle, have very little debt and lots of cash. Agnico will have $1 billion of cash. So on the downside, frankly, is quite limited as far as the mining industry. The mining industry hasn't gone crazy as far as acquisitions, other than Newmont a couple of years ago. But right now, there's tuck-in acquisitions, smaller acquisitions, nothing to stretch the balance sheets. So the gold mining industry, in turn, are doing share buybacks, and that's a way, increasing dividends. That's a way to increase the returns. Interesting that when you look at the gold mining industry on a price to earnings basis, price to cash flow, I haven't seen it as cheap for decades. So we haven't got to the so-called bubble stage as we have in the tech stocks and that.
All right, silver's catch up. I mean, silver's pushed back above $40, a 14-year high, John. I mean, is that sustainable industrial plus investment demand or late cycle bet that you'd fade?
That's a good question. Both are big factors here. Mm-hmm. The dilemma for the mining industry, silver in particular, is that permitting is a real dilemma. And You see Pan American buying mag silver and that to increase its silver. That's a really good silver mine. And they got it at a pretty good price, frankly. So my expectation is there'll still be push up, still continued demand for silver.
John, I got to end off by asking you, what do you think about copper at the moment? I just saw some stats coming out of China. China's copper output is set to dip this month, right? And U.S. tariffs are shifting flows. Does this mean tighter supply ahead or just short-term noise against what we see as this bigger AI story? What's your take?
It's a combination of both. We have difficulties. We see tech and QB having their problems. The mining industry, as you know, Devan, is a difficult business. And so you're having these supply disruptions. That's normal. That's to be expected. The news from China, that has caused it. To me, it's noise. The underlying force for the metal is upwards. We're going to need it for not only AI, but there's just the boom, particularly in China, is an underlying force.
Yeah. Listen, we've got a couple of seconds. I got to ask you, I know this is going to be published before the job numbers coming out of the US, but that's going to be a big one, isn't it?
Well, the job numbers are not expected. Frankly, what's happening is that the parts of the U.S. economy are really slowing down. The job numbers, all the anecdotal evidence is that they are going to disappoint the market. The market itself there's a lot of liquidity still. There's expectations, as you mentioned earlier, of a rate cut. I suspect that if there is a rate cut, it will disappoint everybody, including Mr. Trump. The reality is that there's a war in the United States, and it's a war between institutions, between the administration. That will fester and continue. Sadly, this means more uncertainty. The best Trump trade, frankly, is gold.
Well, John Ing, it's always a pleasure. Thanks very much indeed for those insights.
Good to be here.